Welcome to HDIN Research. So, Roland Corporation, a giant in the electronic music world, just released its numbers for 2025. And honestly, they're a little baffling. At first glance, it looks like a story full of contradictions. But if you look just a little bit closer, a very clear picture starts to form, and it's one of resilient recovery. It shows a company really setting the stage for a high-profit future. So, let's dig in.
And yeah, here's the puzzle right up front. On one side, Roland's revenue, it held pretty steady, even grew a little over 1%, which is pretty good given all the global economic headwinds. That signals stability. But then, you look at the other side, and you see net profit just collapsed by almost 64%. So what's the deal? Is this a company in real trouble, or is something else entirely going on behind the scenes?
And that right there is the big question for any investor, isn't it? The answer? Well, it's definitely not in the headlines. To find it, we've got to peel back the layers and really look at the strategic decisions that led to this very specific, very strange-looking financial result. Okay, so our investigation really starts with this one single massive event that basically skewed the entire profit and loss statement. We have to unpack what they call a non-recurring impairment charge. The number is just staggering, almost $26 million. And this entire charge, it's all tied to one thing: their 2022 acquisition of the American drum brand Drum Workshop, DW. To put it simply, the growth they expected from that deal just didn't happen fast enough, which forced the company to write down the value of that asset on their books. So was this a complete disaster? Well, from an accounting strategy point of view, not really. This is a classic big bath. What it means is management is choosing to take all the financial pain in one single year. It's a deliberate move to clean up the balance sheet, absorb the hit from the acquisition right now, and get rid of any future drag on their earnings. And that's the whole logic right there. By taking this hit in 2025, Roland basically gets to reset the game board. They can walk into their new 3-year strategic plan, which starts in 2026, with a totally clean slate, free from the burden of this underperforming asset. It's a pure, forward-looking play. So if we just mentally put that $26 million distortion to the side for a second, what do we actually see? Well, now we can finally get a clear look at the true health of Roland's core business.
And the first piece of evidence is pretty powerful: their cash flow. Operating cash flow didn't just stay positive, it jumped by nearly 17%. This is the actual cash they're making from the day-to-day business of selling instruments. And it tells you that the fundamental engine of the company isn't just running, it's running stronger than ever. So where's all that strength coming from? Well, percussion, led by their awesome new V-Drum series, is a huge and growing segment for them. And even more important, you've got their creation and services category. This includes their high-margin software, like the Roland Cloud subscriptions, and that's the fastest growing part of their entire business. You add in the legendary Boss guitar brand, which just keeps chugging along, and what you have is a really healthy, diversified portfolio. Of course, this kind of performance didn't just happen in a vacuum. Roland's management was actively steering the ship through some pretty significant global challenges all year long. I mean, just take a look at where their money comes from. North America and Europe, together, make up over 2/3 of Roland's entire business. Now, this heavy reliance on Western markets, it created a major vulnerability when U.S. tariff policies started to shift, and that became a serious headwind in 2025. But their response was incredibly swift and effective. They did what's called a zero-base review, which means they scrutinized every single cost from the ground up. They adjusted prices strategically, and they sped up the process of shifting production out of China and into their main facility in Malaysia. And you know what? Those actions successfully absorbed most of that cost pressure. And hey, speaking of China, a market that's been a real drag on their performance for a while, we're now seeing clear signs that it's finally bottoming out. Sales of core products like digital pianos actually started to recover in 2025, which suggests there might be a nice tailwind for future growth coming from there. So after weathering the storm and wiping the balance sheet clean, Roland is now making a big pivot to the future with a really ambitious new strategic plan. And when I say ambitious, I mean it. These targets are bold. They're not just aiming for revenue growth, they're targeting a more than 50% increase in operating profit. But the real headline here, the number that should make every investor sit up and take notice, is this: they aim to quadruple their return on equity, taking it from 5% all the way up to 20%. So how on earth are they going to get there? Well, it's through 3 strategic pillars.
First is direct connect, which means strengthening their direct-to-consumer sales and really expanding those high-margin Roland Cloud services. Second is innovation, using AI and pushing into new electronic instrument categories. And third, a really focused expansion into key emerging markets. It's a crystal clear roadmap. So what's our final verdict here at HDIN? Look, Roland's 20% ROE target is a huge challenge. Let's be clear about that. But we believe it's actually achievable on one critical condition. They have to truly transition from being just a hardware company to being a music experience provider. And the only way to do that is by dramatically scaling up their asset-light, high-margin software and cloud services. That is the key to unlocking their long-term value.
So, there you have it. Behind the confusing headlines of 2025, we find a company with a really resilient core business and a clear, ambitious vision for what comes next. For more in-depth analysis, you can always find us at HDIN Research.